Lutz Kilian with us. Lutz is professor of economics at the University of Michigan in Ann Arbor, and he has been research visitor and consultant for the International Monetary Fund, the European Central Bank, the Bank of Canada, and the US Energy Information Administration, among others. His research interests focus on time series econometrics, empirical macroeconomics, and energy economics. Lutz is a recognized worldwide leading expert in the econometrics of oil market, with a large number of scientific publications on the sources of fluctuations in the price of oil, the transmission of oil price shocks, and the role of speculation in oil markets. He is also author of more than 80 publications, with articles appeared in journals, important journals like Econometrica, the Journal of Political Economy, and American Economic Review, to mention a few. He has also authored a textbook with Helmut Luetpohl on structural vector autoregressive analysis. Lutz has served as associate editor of the Journal of Business and Economic Statistics, the Journal of Development Economics, and the Journal of Economic Dynamics and Control, among others. Okay, so thanks for coming, Lutz. Today he's presenting a paper on lower oil price and the US economy. Is this time different? Very interesting question.
Thank you. It's a pleasure to be here. This is joint work with Christiane Baumeister and Xiaoqing Zhao. The starting point for this paper is the observation that after June of 2014, the price of oil in global markets dropped sharply, and it stayed down throughout 2015 and into 2016. Now, many economists looked at this picture and said, well, if you have such a large, almost historically unprecedented decline in oil prices, that has to be good for the economy. So the International Monetary Fund, for example, raised its growth forecast for US real GDP to 3.5%. What actually happened was a bit different. So this table shows you average growth rates before the oil price came down, in this column here, and average growth rates after the oil price came down. So when you look at real GDP, for example, you see that the economy, the US economy, used to grow at 1.8%, the oil price came down, and growth went up to 2.2%. Now that's clearly not 3.5. It's far from 3.5. When you start breaking down real GDP into its components, you see some interesting patterns, though. For example, private consumption used to grow at about the same rate as real GDP, 1.9%, before the oil price came down, but it accelerated to 2.9% after the oil price came down. So it seems there was some response in private consumption. If you look at investment, non-residential investment in contrast, that used to grow at 5.1%, but it came down to 1.5%. And so really there's a lot going on behind the scenes. It appears that there was some stimulus for consumption, which was offset, at least in part, by non-residential investment. Now, why did investment decline? When you break up investment into the investment by the oil sector and the investment by other businesses, it turns out that if you look at non-oil sectors, 4.9, 4.6, really not much has changed. What has changed is a change from +7 to -48% growth in oil-related investment. Right? And that's clearly where this is coming from. I'm going to elaborate on that. Now, finally, you see exports and imports, the external sector of the US economy. For imports, there isn't much of a change. It goes from 2.3 to 2.9%, but exports drop from 3.2 to 0.7. Now, it turns out that's not a coincidence. One of the reasons why the price of oil declined after June of 2014 was a slowdown in global real economic activity. And if the global economy slows down, that means fewer exports for the US economy. And so that explains why you go down to 0.7, which of course also pulls down overall US growth. So the big question is, should we have been surprised by this? Well, obviously the International Monetary Fund was surprised. A lot of other people were surprised. But there is a wide range of opinions as to whether this was expected or not and why. So I'm going to try to review that discussion, that debate a little bit. Now, one story that you find in most macro models of the transmission of oil price shocks is And people say, well, when we see an unexpected decline in the real price of imported crude oil, that matters for the economy because it affects the cost of producing domestic goods and services. And the idea is that if domestic firms use oil or oil products as an input, if the price of those inputs goes down, your cost drop, that means you should be able to be more profitable. You should actually increase production. And if that story were what's going on, then of course you have a puzzle, because we had this huge decline in the price of oil. Why then is it that we don't see a big economic expansion? So from that point of view, indeed, this would have been surprising. Now, there is another also equally important story that you find in some macro models, which is that when you see an unexpected decline in the price of imported crude oil, this matters because it increases the demand for other domestic goods and services. And so the intuition is that if you are a consumer and you end up spending less at the gas station because the price of gas has gone down, well, then you have money in your wallet left that you can spend on something else, right? And so that presumably can be spent on domestic goods and services, creating a stimulus. The question then is whether the actual consumption growth that I showed you earlier in that table is about what you would have expected based on this story, or maybe consumption growth should have been higher. One reason why that might have happened is that it is not obvious that refiners passed on lower oil prices to retail gasoline consumers. And if they didn't pass it on, well, then of course consumers wouldn't have reacted. And so one possible story we need to look into is whether they actually, whether these declines in prices actually were being passed on. Now, there's a second reason why you might not see consumers spend more. And that is a story where people say, well, after the financial crisis, which really shook up consumers, they changed their behavior. That is, in the past, when consumers had more money left in their wallet when oil prices went down, they turned around and they spent it. But this time, they instead chose to pay off their credit card debt, they lowered their mortgage, they maybe even started saving. Well, in that case, if they're not spending it, but they're saving it, clearly you wouldn't expect to see a stimulus, and so that's another story why this time you might not see much of a stimulus. And then there's a third idea here, and that relates to the consumption of motor vehicles. I didn't stress that, but in the earlier table there was a line that showed that when the oil price came down, the growth of consumption of automobiles actually became negative. The usual presumption most people have is to say, well, when gasoline is cheap, people buy more cars. But that's obviously not what happened. The question is why. One, consumers versus come back up. In other words, increased uncertainty about future gasoline prices prevented people from buying cars. So the story in a nutshell says that, yes, you could go out and buy a pickup truck now. Pickup truck now, and in here for the price of gasoline and of crude oil, you haven't bought that car, right? Because you're in a new car and see until the situation is clear. So a third, it accounts for about half of the oil consumed by the US economy. A quarter, I should say, not half, of the oil consumed by the US economy. One concern has been that as this oil sector became more important, lower investment in the oil sector might have dragged down investment in other sectors. So there has been discussion, for example, that the steel sector is not investing because there are not enough orders from the oil sector, because the oil sector doesn't need any steel products and related equipment. That could be an explanation. There is another notion that simply when the oil sector, when domestic oil production grows, given that domestic oil production is part of and that sector prices come down, well, that's a real reason why there. So that has to do with natural can't just loans to potential homeowners. They were looking for new clients. One, of course, shale oil company borrow. It see after 2008 that they were a sense that a shale company below the ground that can collateral was valued the price of oil. When the price of oil fell sharply, of course, that collateral wasn't worth much. It suddenly looked very risky. And so the fear is that, similar to the mortgage crisis, the financing provided by banks was disrupted because essentially banks are in a retrenchment mode. Now, a final thought here is that, of course, when you see a very big decline in the price of oil, you wish that you could move the capital and labor that is tied up in the oil sector to another, more profitable sector. The problem with that is that capital and labor often are specific to a certain sector. For example, you might want to put an oil worker to work in Silicon Valley's chips, computer chips, but he's just not trained to do that. So in the short run, basically, this person is going to be unemployed. Likewise, capital in an oil rig now is going to be in some parking away form of capital. That means overall growth. So let's explain why there might be growth than people expected. What I want to do is look at this problem through the lens of conventional economics of the emission price shocks. I'm going to start with the basic models, then gradually complicated, always looking for. So the two most big stories people have are the demand channel story. Supply channel story, as mentioned, you see a down erosion in the cost of that economy. Alternatively, through the demand channel, you might see an increase in spending. That increase in spending can come from consumers, but it can also come from business investment, possibly in response to higher consumer spending. These stories are not mutually exclusive. In theory, both could be happening at the same time. But what is the evidence? Well, there is actually an earlier literature that has looked at this question and has provided more and more evidence over time that the demand channel is much more important quantitatively than the supply channel. So it's natural to look at the same question in the context of this recent oil price decline. I'm going to show you two pieces of evidence. One is based on industry-level stock returns, normalized relative to the overall stock return since June of 2014. And the other is looking specifically at data for the US transportation sector. So what we did here is quite simple. We argued that the main economic event after June of 2014 has been the decline in the price of oil. There have been no important changes in economic policy, for example, over that period that we need to worry about. That means if the supply channel were correct, then those industries that heavily depend on oil products or crude oil as an input now should be doing great compared to the overall economy because they got a big boost from lower oil prices. What are these sectors? There's the petroleum sector, there's chemicals, there's rubber and plastics, there's logistics. So how are these industries doing? Well, it turns out not very well. Many of them are doing worse than the average economy does, the average stock return does, and some of them are doing about average. So this is not the pattern you would expect if the supply channel were really important, because then these sectors should be booming. What are the sectors that do boom? Well, those are down here, and they have one thing in common. They're all sensitive to consumer demand. Now, the first line here shows candy and soda, beer and liquor, and tobacco. So why are these there? Well, think of your typical American customer driving his pickup truck into the gas station. He fills up, and he finds he has some money left over. He brought more money, but now the gas price is down, so what do? You grab a candy, maybe a beer for tonight, and a smoke for the way, and then you walk out. So in other words, you spend some of that money that you had in your wallet. And so this is not a coincidence that you see 16%, 10%, 7% above average returns for these sectors. The second line shows you tourism, restaurants, hotels, and motels. It's quite natural that with lower gas prices, people go for a drive. They might even go on vacation. Well, that means sectors catering to these needs will be doing far better than average, and that's exactly what you see here. The third group here is retail sales, which goes up by 14%. Interestingly, if you look at Amazon and Home Depot, where you can spend a lot of money, those are doing really well. If you break down retail sales, you look at different components, note that the apparel industry, so that's basically clothing, is also doing very well, right? These are, again, items that people might choose to spend some extra money on if they have the money. So this pattern is very much consistent with the demand side being important and not being important. So then say, well, there is. This is volume in the US sector. We looked at it, just going to show you three, and finally, air revenues. The line in the period leading up to the oil price decline, you see lines standing slightly. Now, what happens afterwards is that the line and the green one standing upwards. What have we did? Given that most of the crude oil used by the US turned into transportation, you would have expected should be trending up much more than they do, because there should be boom in the transportation sector now that the input cost has gone down. But obviously, that's not what's happening. In fact, one of those lines, the blue, actually is going down. Turns out that is explained by a policy that forced many companies to close down. Coal used transported by rail, that segment of rail fell away, and that's why that big decline. If it weren't for that, all of them would just go at exactly the same growth. So that is additional direct evidence that this supply channel that everybody is interested in apparently is not so quantitatively important. So what that means is that we should focus on the demand side. Now, if you take as our premise that the main transmission channel is on the demand side, how does that transmission work? Well, if you go back to a standard macro textbook, they would tell you that shocks to the real price of imported crude oil are terms of trade shocks. That is, they affect the relative price of imports and exports. And the idea is that if that relative price changes, that makes you richer if you live in an importing country, if the price of your import goes down relative to the price of... What the basic textbook model is missing is a few things. The first fact is that nobody in this room has ever bought crude oil. We don't buy crude oil. There's nothing we can do with crude oil. What we do buy is motor fuel, which is a refined product derived from crude oil. In fact, there are not many firms that buy crude oil either if you leave out refiners. Now, it turns out that changes the analysis because we really need to start thinking about the price of motor fuel, not the price of crude oil. And I'm going to come back to that in a second. The second complication is that in the basic textbook model, we equate consumption and output. But of course, if you also have investment in the economy, you have to allow for the possibility that private investment and private consumption might respond differently to a given terms of trade shock. A third complication is that there are countries, such as the United States, that have sizable domestic oil sectors. And if there's domestic oil production, that's not something that's allowed for in the basic terms of trade shock model. And that's important because obviously the oil sector is going to be disadvantaged by a decline in the price of oil, even when everybody else is happy about that decline. So there's going to be a trade-off. And then finally, we need to split up the oil sector investment and the non-oil sector investment because they presumably will behave very differently. So these are all things you don't find in textbooks, but that are absolutely important if you're trying to understand the implications of this oil price decline. So the textbook view is nicely summarized by a quote by Janet Yellen, long before she became chairwoman of the Federal Reserve Board. She was talking in 2011 about higher oil prices. And so her argument is that higher oil prices lower American income. Now, why would that be? The intuition is that if you have a country that is a major oil importer, then when you spend money on oil, directly or indirectly, that money is going to be transferred abroad. It's going to end up in places like Saudi Arabia, if that's where you get your oil from. The problem is that people in Saudi Arabia are not necessarily going to spend that in the United States. So that means you're essentially removing this money, this income from circulation. It is a little bit like a tax in a Keynesian model where you dump the proceeds into the ocean. It's gone, right? It's not part of the economic system. Which is why many people have compared higher oil prices to an oil tax. And as we know, with any tax, if you raise taxes, well, that's going to dampen consumer spending, and then this consumer spending is going to affect real GDP through a Keynesian multiplier. Now, if you take this story and you apply it to the context of falling oil prices, that's a little bit like a tax rebate. It's like getting a check in the mail from the tax revenue office saying, oh, we have some extra money for you. Well, that presumably means people are going to go out and spend, and that is going to stimulate the economy. The problem with this very basic story is that, as I just mentioned, consumers don't buy crude oil, they buy motor fuel, and so we have to be a little bit careful. What we need to focus on is the change in the price of motor fuel that is caused by the decline in the price of imported crude oil. And so there are really 4 steps. The first is that if, for the sake of argument, the real price of crude oil increases, what does that mean? Well, clearly the price of gasoline then also has to increase, but by how much? Well, it depends on the cost share of crude oil in producing gasoline. In the United States, the cost share of crude oil in producing gasoline is about 50%. What that means is if the real price of imported crude oil declines by, say, 50%, you would expect the price of gasoline to decline by 25%. And that obviously makes a difference because the effective price change, the effective terms of trade shock from the consumer's point of view is of a very different magnitude than the original oil price shock. Now, if you figure that out, because the demand for gasoline is price inelastic, we know that from a number of recent studies, consumers will spend more on gasoline than before the gas price went up. The problem is, to the extent that this money you spend on gasoline is being transferred abroad and disappears from the economic system, that means aggregate consumer discretionary income, and therefore aggregate consumer spending is going to fall. If you lower spending, then through a Keynesian multiplier, that leads to a decline in real GDP. So those are the 4 steps that we have in mind here. So how do we measure these effects? Well, a useful starting point is the following simple thought experiment. Suppose you you purchase a certain quantity of gasoline in a given month, say. Let's call that quantity CT. That's your consumption of gasoline, CT superscript gas. You're going to spend, in real terms, CT gas times the real price of gasoline. Now suppose, after the gasoline price changes, you want to purchase the same quantity of gasoline. Well, then you would spend, over here, CT gas times the new real price of gasoline. That difference between what it costs you to purchase the same quantity of gasoline, normalized relative to what you spend on everything else that is not gasoline, that gives you a sense for how important this shock is to consumers. Now, you can actually rewrite that expression and show that it's equivalent to the percent change in the real price of gasoline weighted by the share of consumer expenditures on gasoline in their total expenditures. And that's very intuitive. It's saying, if you don't spend any money on gasoline because you walk to work and you don't have a car, you don't care, well, then presumably you're not going to be affected to first order by this change in the price of gasoline. If you spend a lot, obviously this is going to matter more. In practice, very often people measure this share by the current monthly share of your expenditures on gasoline. So what that implies is that if the real price of gasoline falls unexpectedly, well, then that means your purchasing power is going to go up. If the real price of gasoline goes up unexpectedly, then your purchasing power is going to go down. That's pretty clear. Now I'm going to add another thought, and that has to do with how consumers, at least in the United States, form expectations about the real price of gasoline. There's a literature that has shown that they essentially use a no-change forecast. If the current real price of gasoline is equal to a certain number, they're going to assume that in expectation, this is not going to change. That implies that any change in the price of gasoline, the real price of gasoline, and therefore any change in the consumer's purchasing power is a surprise or a shock to that consumer, which will allow us to measure these changes in purchasing power and treat them as shocks where we can trace out the response of private consumption to these shocks. That's going to be our strategy. Now, here's some motivation for that last assumption. This is data from the Michigan Survey of Consumers, where we first, in blue, plot the current gasoline price adjusted for the expected change in the gasoline price in the survey data. And what that will give you is literally the expected price of gasoline. Then the red line is taking the current gas price and adding the consumer survey measure of inflation expectations. And it turns out the red line is almost the same as the blue line, which implies that the forecast is being formed by assuming that the current gas price stays the same in real terms. Right? Whatever difference there is between what you expect in the future and now is driven by inflation expectations. That's the rationale for treating this as a shock. Now, before we go on, I want to do a slight detour, and I'm going to make the point that the weighting of the change in the real price of gasoline by the consumer expenditure share is also consistent with standard New Keynesian models. The particular New Keynesian model I'm referring to is one that was written down by Blanchard and Galli in a book in 2010. Their model is a little bit simpler than my original story because they assume that oil and gasoline is the same good. Obviously it's not, but that's a simplifying assumption. In their model, oil enters both the utility function and the production function. Right? So we allow for both channels. Notation here is that C is private consumption, Y is real GDP, alpha is the oil share in production, and then you have the expenditure share and the real price. What they derive is that in equilibrium, after log linearizing the model, they get this expression up there, which if the share alpha is close to 0, which it is in the data, can be approximated by this equation down here. So what is that telling us? It's telling us that the effect of a change in the real price of oil/gasoline on consumption, holding constant value added, is obtained by weighting the change in the real price of oil based on the expenditure share on oil/gasoline. Right? So this is not a coincidence. The same intuition that I gave you earlier would also hold in a formal model. So the next question then is to quantify the consumption stimulus that arises from these purchasing power shocks. The first question we have to address is whether this recent oil price decline was being passed on to retail consumers of gasoline. We do a fair bit of analysis of this question, and we show that this pass-through has been essentially perfect. There's no problem there. These price declines were actually being passed on, subject to the cost share in producing gasoline. So we can compute our percent change in purchasing power, which is our purchasing power shock effectively. We can compute delta CT, that's the growth rate of private consumption, and run a simple model which says the growth rate of private consumption depends on a constant, lagged consumption growth, and current and lagged purchasing power shocks. Now, you can use this model to estimate the cumulative effect of purchasing power shocks since June of 2014 on the level of private consumption. Essentially, this is done by viewing this as a restricted vector autoregression and doing a historical decomposition. Now, it can be shown also that this model is not only adequate if all of your gasoline and crude oil is being imported, but our results would be invariant to the share of crude oil and gasoline imports being anywhere between 0 and 1. You don't even need to know what it is. It turns out that term will cancel. Now, in practice, this is what this looks like. The top panel shows you the percent change in the US real price of gasoline and other motor fuel. The second panel shows you the share of gasoline in consumer expenditures. You see that in the early 1980s, that share went up to close to 5%, then it came down, and in our period, which is 2014, it was approximately at its average value. If you take the product of the first and the second panel, then you get our measure of US consumer purchasing power shocks. That's essentially what is in the model. Now, you might object that over time, the dependence of the US economy on oil and gasoline imports might have varied. In fact, as I'll show you in a minute, it has varied. So the question is whether that is something you need to worry about, something that might affect our estimates. The way to formalize this is to take the original measure of our purchasing power shock, that is this part, and post-multiply it by an adjustment factor. The way this adjustment factor is constructed is as follows. Suppose you take a gallon of gasoline at the gas station. Some of that gasoline will come from gasoline that was imported from abroad. In the US, that fraction is very low, like say 2%. So that is obviously money that would go abroad, because if you buy that part of your gasoline, that's going to have to be paid by paying someone abroad. It's going to leave the economic system. The remaining 1 minus 2%, or 98%, that's gasoline that was produced domestically. Now, when you produce gasoline domestically, you're going to do that based on some crude oil that is produced in the United States and some crude oil that had to be imported. It's only to the extent that you imported that crude oil that your money will migrate abroad. So we're going to have to weight this with a share of net oil imports in the total use of crude oil. Right? So this additional adjustment factor then tells you how the import dependence has evolved. This is a plot of how this import dependence has evolved. You see that at times you were a little bit over 20%, we went up to close to 70%, and then things came back down. Now it turns out that in June of 2014, we were just about at the average share, close to, I think, 49 or 50%. So that suggests that this might not be such a big deal. In fact, when you compare the purchasing power shocks in the original specification, which is the top panel, and the alternative specification with the adjustment factor, you see that the shocks here at the end of the sample are actually quite similar. What is different is some of the earlier shocks, which then potentially could give you different regression estimates. So this is something you have to try out. But as it turns out, empirically, our results for June 2014 and beyond are not sensitive to which specification you choose. Qualitatively, you get the same answer. So I'm going to focus on the baseline model. Now, before we move on, one of the questions we got was how what we do is different or different from or similar to the Washington, D.C. consensus. That is, how policymakers in Washington, D.C. think about this problem. There is no better summary of what that consensus is than to look at what the Council of Economic Advisors does. They are supposed to advise the president. And when you look at the Council of Economic Advisors, they are working with this type of formula here, which says that the way you measure these purchasing power shocks is to take the percent change in the nominal price of crude oil, and you weight that with a share of nominal net oil imports over nominal GDP. And so just at first sight, you'd say, well, this formula looks a little bit different from the formula that we proposed earlier. And there's an obvious concern, how can we reconcile that? Now, it turns out that you can show that this formula actually can be derived from our approach. In order to get this formula, you need to make some additional assumptions, simplifying assumptions, 4 assumptions in particular. Your first assumption has to be that in the US economy, consumption equals real GDP, which is a different way of saying that investment in the US economy is 0, government spending in the US economy is 0, the balance of payment is 0. And if you're making those assumptions, that implies that consumption equals output. That's assumption number 1. Assumption number 2 says gasoline and oil are the same good. Assumption number 3 is there is no inflation in the US economy, which implies that whether you talk about the real price or the nominal price of oil makes no difference. And finally, you need a small assumption saying that there is no change in US crude oil inventories. And if you buy all of these assumptions, and you plug into our original formula and start simplifying things, you get exactly this formula up there. Now, does that mean you should be using this formula? Probably not, because those 4 assumptions are clearly at odds with the data, and there's really no reason for taking shortcuts. It's not hard to compute this correctly. But the main point I want to make is that conceptually, what the Council of Economic Advisors does is very much in the same spirit, at least, as we're trying to do. Model and back out what the consumption stimulus is. The short answer is, cumulatively, this sequence of purchasing power shocks since June of 2014 stimulated consumption by plus 1.2%. We're going to have to come back to the question of what that means for real GDP. I'm going to do that later. I just want to mention that we can also do the same exercise allowing for variation in the oil and gasoline import dependence. The numbers are going to be a little bit different, but the substance of the results is the same. So the question is whether this 1.2% stimulus result is what you want to base the discussion on. Because remember that this was based on postulating a linear relationship between consumption growth and purchasing power shocks. But what if that relationship were not linear? If it were a nonlinear relationship instead, well, in that case, maybe that 1.2% number really isn't adequate. It's not accurate. Now, there are 2 reasons why some people think that a linear model here might not be enough. The first economic story points to the role of higher uncertainty about future oil and gasoline prices. That is an idea that goes back at least to Bernanke in 1983, who wrote down a real options theory model to make the case for this channel. There's a second story going back to work by Jim Hamilton, which focuses on frictions to reallocating capital and labor from one sector to the next in response to changes in relative prices. Both of these mechanisms would imply that the response to a positive oil price shock is not symmetric with respect to the response to a negative oil price shock, right? Symmetry would mean one shock is essentially up to sign the mirror image of the other. Asymmetry means, for example, that a positive oil price shock gives you a big economic decline, but if you get a negative oil price shock of the same magnitude, then you see no expansion of the same magnitude in absolute terms as the decline in the first case. So this is something we need to worry about. Now, I'm going to look at this in this context, starting with the uncertainty story. So what is that uncertainty story? The story is that if you are a US consumer, and if you're uncertain about the future evolution of the gas price, in other words, if you worry that now that the price came down, it might go back up, then you might choose not to buy a car. Because if you choose to buy a car, in particular if you choose to buy a car that consumes a lot of gasoline, that might turn out to be a bad choice. So you're going to exercise the option of waiting, which means you're not buying a car right now. The problem is, how do we measure consumer uncertainty about gasoline prices? Now, the focus here is on what consumers expect, which is not the same thing as what financial markets expect. It's not the same thing as what econometricians expect based on fitting, say, a Garch model. In fact, we don't really know what that is, but it's kind of important. So we propose the following proxy. There is a literature in macroeconomics that has observed that when you look at survey data, evidence of increased dispersion in the survey responses across survey respondents, across households, tends to be correlated, at least at lower frequency, with increases in uncertainty. So what we can do here is show that the dispersion of the question of what you expect the price of gasoline to be goes up between June of 2014 and early 2015, which is when you had the biggest decline in the price of oil. And it does this both at the one, if you're buying a car, you're going to hold on to the car for a while. So the car, let's say 5 years, will show that both long uncertainty goes up is going to be important here. So that says, well, it as though there might be an increase in uncertainty. According to this model, what should happen is that people stop buying cars. Look at the upper panel here. It shows you the sales of autos and light trucks. That's data from the BEA. Between June of 2014 and early 2015, indeed, not many cars were being sold, not many autos were being sold. After that, you see sales pick up. Side, you would say, well, that might be consistent with uncertainty playing some role, and that would imply that there would be a nonlinearity and we have to be careful. There are two problems with that argument. The first problem is shown in the lower panel, which shows from the same survey current buying conditions for automobiles. What happens is that consumers decide that with a decline in the price of oil, until the price of oil hits rock bottom, conditions for buying a car steadily improve. They're really good, and they stay high for the rest of the sale. So that's what we have, and not car for now. That's not consistent with trucks and not small cars. Now, if you buy a light truck, you know you're buying a gas guzzler. And that would make no sense if you were worried about uncertainty about gas prices, because if you think gas prices are going to, you must buy a truck. So by revealed preference, these guys couldn't care less. So these two pieces of evidence that this uncertainty story is not very useful for understanding what happened in the period since June of 2000 means this first story giving you an asymmetry or nonlinearity can be discarded. So what about the second story is that any change in the relative price of oil, in particular a decline in the relative price of oil, means that you now have capital and labor that is in the oil sector, and you'd rather move that capital and labor into some other sector can be used more profitably. So that problem with that are frictions that prevent you from moving capital and labor. And if there's such frictions, that would imply that in the oil sector, labor and capital inputs effectively go down. Because if you have a worker who's sitting there idle not doing anything, well, he's not producing. If you have a machine that's turned off, that machine is not producing. So that means input must go down, and that could have a potentially big effect on real GDP. What we need to do then is to quantify the underutilization of capital and labor, and then we need to show how much that matters for real GDP. So let's try to do that, starting with the labor side. This is a picture of the US national unemployment rate. Notice that there was a big increase in unemployment following the financial crisis. Then you see the unemployment rate starts dropping pretty steadily. This line here, that's June of 2014. It turns out this decline in the unemployment rate continued at pretty much the same rate after the oil price fell. That's not what you would have expected if the fractional unemployment story were important, because that story says that when the real or relative price of oil declines, that means there's going to be unemployment. That is, in the extreme case, you would see a reversal of this trend, but at a minimum what you would expect is a decline a reduction in the rate of decline of the unemployment rate. And at least looking at this picture, that's really not there. In fact, when you look at the last time we had a big oil price decline, that was in '86, the unemployment rate fell quite steadily. There was no evidence of an increase in the unemployment rate. So that seems to be saying that perhaps this is not an important story at the aggregate level. Obviously, this is aggregate data, and there might be all kinds of other things going on, so this is not as positive, but it is suggestive. So let's dig a little bit deeper. We now focus on those states in the United States where a lot of oil is being produced. Because if fractional unemployment is important, well, then it has to be in Alaska, Montana, New Mexico, etc., in those states. So what do we know about the unemployment rate, the change in the unemployment rate? That's shown in this panel. If you look at the green numbers, you're seeing that out of those 7 oil states, in 5 of those 7 states, the unemployment rate declined, which is the opposite of the predictions of the fractional unemployment model. In fact, the 2 exceptions are Wyoming, but Wyoming is special because that's where a lot of the coal companies are that Obama closed down. And so a lot of the increase you see, which is not very big in the first place, has to do presumably with coal and not with oil. If you look at North Dakota, you see plus 0.4%. What does that mean? It means the unemployment rate in North Dakota increased from 2.7% to 3.1%. For many countries in the world, that would be a pretty good unemployment rate. So it's not exactly what you would call a disaster. Now, you might be concerned that these declines in the unemployment rate could be somehow an artifact of migration, that people who lose their job in North Dakota pack up and move somewhere else. And so we do a fairly detailed analysis of labor market data and show that that cannot possibly explain these patterns. So that means, as far as the labor side of the fractional unemployment story is concerned, this is not important. Now, when we presented these results, people said, but of course, labor is just not very important for the oil sector, so therefore that's exactly what you would have expected. Be that as it may, if it's not labor and you still think this is important, that means it must be on the capital side. So what do we know about the capital side? Well, we know it's a lot harder to measure. So what we know is that, for example, the number of oil rigs declined from its peak in October 2014 by 75%. We know that the number of petroleum rail car loads was down 30%. So what that means is that there are a lot of rigs parked in some parking lot, or maybe rail cars parked in some rail siding, and they're not being utilized. But that's only the tip of the iceberg, because it's not just the oil sector that we worry about. It's that if you go to one of those oil states, nobody is going to the local bar anymore. So the equipment in the bar is underutilized. Nobody is staying in the local motel. Nobody is going to the local Walmart. So a lot of infrastructure, private and public infrastructure in those states is being underutilized. We have no way of measuring that, but presumably that could be important. So one indirect way of gauging these effects is the following thought experiment. We know average US real GDP growth. It was 2.4%. Suppose that we decide to recompute that real GDP growth after excluding all 7 of the oil states. Well, if we do that, we find the difference in real GDP growth is 0.1 percentage points on average. That is very small compared to what needs to be explained, which is why we didn't get the 3.5% growth the IMF predicted. So, well, we can conclude that whatever the effect of the underutilization of capital is in the oil states, that cannot be explaining what we're seeing in the data. So that means also on the capital side, that fractional unemployment story is not supported. So that means both the uncertainty and the fractional reallocation story can be discarded. It means our initial estimate of 1.2% consumption stimulus actually is likely to be trustworthy. So that means we can now move on to the next spending component. We move from consumption to private investment. And there it makes sense to split investment into oil and non-oil investment. Here we're looking at the non-oil part. And we are going to assert that the response of investment is likely to be symmetric, much like the response of consumption. And in fact, that the response of investment is ultimately going to be driven by changes in consumer demand, and therefore it's going to depend on the same purchasing power shock that we already used earlier, except averaged at quarterly frequency. We can run a very similar model at quarterly frequency, and we get a stimulus of 2.2%, in addition to the 1.2% consumption stimulus that we quantified earlier. So that means we need to move to oil investment. Now, that is complicated by the existence of shale oil. So the first concern you might have is because shale oil production is part of domestic value added. If the shale oil sector shrinks, that means that real value added for the US economy should shrink. Now, how important is that effect? Well, the problem is we don't have data on the shale oil sector. We don't have data on value added for oil and natural gas. The only thing we have is data on the mining sector, which includes coal and lumber and all kinds of other things. If you take all of this together and we subtract the component of value added coming from mining, this affects the overall growth rate to the second decimal place. So in other words, this direct effect on value added is absolutely negligible. You don't need to worry about that. But that doesn't mean that shale oil doesn't matter, because when you're worried about growth in real GDP, the contribution of shale oil to the growth rate could be much bigger than its contribution to the level. And in particular, one channel by which this could happen is changes in investment, because investment is much more volatile than other components of real GDP. Notice that, as mentioned earlier, overall private fixed non-residential investment over the relevant period was 1.5% after the oil price came down. This was really associated with a very big decline in oil investment. The rest of the investment is doing just fine. Now, how important is that minus 48% drop? Well, you have to weight this by taking account of the fact that oil investment is only part of total investment, and investment is only part of real GDP. But when you do all the weighting, it comes down to 0.4 percentage points of real GDP growth. And that's big, right? That's the first big item here we're seeing that we need to worry about. Regarding the additional story about spillovers to other sectors, there's absolutely no evidence for that story. This is really quite simply reduction in oil investment without spillovers. So, in principle, if you take in our consumption result and our investment result, you already see what the story is going to be. Of course, there are people who say that's all not the way to think about it, because the world nowadays is just completely different from what it used to be. Essentially, there are people who assert that there were important structural changes that prevent us from using the models that I was using so far. What are these stories? The first story is a financial contagion story working through the banks. In the paper, we look at this in detail and show the timing is such that this story can't possibly be right, so that can be rejected. Second, there is this notion that consumers don't spend, they save. Turns out that is not supported by the data either. We can discard that story. Third, there is the notion that the existence of shale oil allowed refineries to buy crude oil and turn it into refined products such as gasoline and diesel and sell this to Latin America and to Europe. That's true. In fact, that would be a structural change associated with the emergence of the shale oil industry, but you can quantify this effect and show it's actually quite small. So that's not going to be a first-order difference. A fourth concern is that the macroeconomic response to oil price shocks depends on the composition of oil demand and oil supply shocks. That's something that has been stressed a lot in recent years. Fortunately for us, over the period since 2014, the composition of oil demand and oil supply shocks is just about the same as on average over the full sample. So it turns out that for this period, this doesn't matter much. And so we can ignore this as well, and that can be formalized. And then finally, I already alluded to the fact that if you account for changes in the dependence on oil and gasoline imports, these changes do not undo our results for this particular episode. So there is no structural change. We can just go with the basic models. So let's now take these results for the stimulus on consumer spending and investment spending and put them together, trying to take account of the effect of these spending changes on real GDP through a multiplier and adjusting for the propensity to import. What you find is a private consumption stimulus, this is cumulatively on real GDP, of 0.7 percentage points. You have to add to this the business, non-oil business stimulus of 0.22, that gets you up to 0.92. So far, this is good news, but now comes the minus 0.57 from the oil sector investment. And that even if you account for the petroleum trade balance, essentially wipes out most of the gains. You're left with a net stimulus of 0.39. If you map this into average annual growth, we're talking about something like 0.2 or so. This is absolutely negligible. We showed we go from 1.8 to 2.2%. This accounts for 0.2, about half of that. Right? And so what is that saying? It's saying no one should have been surprised by this result. No one should have been predicting 3.5% growth for the US economy, because obviously when you apply standard models, they tell you that the net stimulus is about zero. Now, let me add another wrinkle here, and that wrinkle is that, as I mentioned earlier, we have to take account of the decline in exports, which presumably is tied to the decline in oil prices because it is one of the reasons why the oil price went down. Roughly speaking, you can bound this effect and argue that perhaps US real GDP growth would have been as high as 2.6% on average if you didn't have that decline in export. So you would have gone from 1.8 to 2.6. That's a little bit better, but it's still just a modest increase in growth. Now, is that surprising? Not really, because there are several studies that have looked at this question historically and have shown that in history, going back to the 70s and 80s and 90s, the effects of oil price shocks have always been modest. They have never been very large, and that's exactly the same result here. So how did the IMF get the number of 3.5%? Well, I don't know the details, but intuitively, they must have argued that in the 1970s and 80s, there were big positive oil price shocks, followed by big recessions. So now if you have a big negative oil price shock, there should be a big expansion. The problem is that that is not what the effect of these big positive oil price shocks was in the 70s. That was only one contributing factor of the recessions, but there were many other explanations. And so if you convolute those, then you arrive at this notion it should be a really big boom. If you do this properly, you don't get that result. So in that sense, the good news is that standard economic models actually are working pretty well, right? So we can be happy with that. Now, you might say, well, would we have expected to see this decline in oil investment? And the answer is, well, maybe yes. Because there was a paper already in 2007 looking at the behavior of spending following the 1986 oil price decline, which was the last time we had a big sustained decline in the price of oil. And in that period as well, we saw a big decline in oil investment. And so it would have been natural to expect exactly the same thing to happen here. In fact, there are people who argue that what is different about the current episode is that oil investment is much more sensitive to changes in oil prices because of shale oil. It turns out when you look at the estimates, the opposite is the case. Actually, shale oil investment is less sensitive to changes in the price of oil compared to what happened in 1986 with conventional oil. Now, when you're thinking about the relationship between changes in oil prices and oil investment, it seems natural at first sight to say, well, the bigger the decline in the price of oil, the bigger the decline in oil investment, this must be somewhat a linear relationship. That is not obvious, because when you are trying to decide whether to invest in the oil sector, you're typically doing a net present value calculation. And you're saying, as long as the oil price is above my break-even price, I'm going to invest. But if the oil price falls below my break-even price, I'm going to stop investing. That says that this relationship is inherently nonlinear. There's going to be a discontinuous adjustment when the oil price falls below the break-even price, and there's not going to be much adjustment when you're above. And so that's saying that the linear model would be a great approximation if you have a country that doesn't produce any oil, like France, for example. But when you're talking about a country that is producing oil domestically, then it could happen that if you're in a range where you're far from the break-even point, that nothing happens. A linear model is perfectly fine. But when the price falls a lot, then suddenly you start seeing a lot of action. So that means going forward, if you want to allow for the possibility that the price of oil might fall to $30, which might have big effects on oil investment in the US economy, you actually have to make that model nonlinear, and that is something we haven't done so far. Another important insight here is that traditionally people associate the importance of the oil sector with the share of oil in value added. And that share is around 3-4% or so for the US economy, and it moves a little bit, not that much. Now, it turns out, according to our analysis, that's not at all what matters. What matters is the share of oil investment in total. The share, the added share, investment share determines how much weight this sector gets and the rest is basically negligible. So that's some interesting implications for research going forward. So I think I'm at the end, so the floor is open for questions. Yes?
Thank you for your presentation, because it looks at the system is more complex. Maybe renewable energies play a role. Investment in renewable energies play a role here now.
That is not so clear in the sense that in the US, the big push has been for using ethanol as a renewable fuel. The fraction of ethanol in the kind of gasoline that is sold at the gas station tends to be fixed at around 10%, which means that you want to think on the margin of ethanol as a complement, not as a substitute. It's not that you can say, oh, I have a lot of ethanol, so now we're going to do gasoline which has 50% ethanol, because most of the cars in the current car fleet in the US could not handle that kind of ethanol component because it's corrosive, and basically car manufacturers say we're not taking any guarantees if you're using that kind of gasoline. So the fraction of cars and trucks that can use that kind of high ethanol gasoline is very small. And so essentially, that is not going to be driving the result for that reason.
Thank you.
So, if you take the title
Yes.
of the presentation, how can you summarize the result of this study compared to those in the 80s?
So there are two questions when we say, is this time different, that may come to mind. The first question is it the case that the models we developed for understanding the impact of oil price shocks still work? Or is this time different in the sense there's some structural break and those old methods simply don't work anymore? And in that regard, we show the traditional models seem to work surprisingly well. The second sense in which this question arises is that there are very few episodes of large sustained declines in the price of oil. The only good example really is 1986, and now we have this 2014-15 episode. Now, when you compare 86 and the current episode, this is complicated by the fact that there were other things going on in 1986. So one concern is that 1986 was also the time of a major US tax reform act, which affected, in particular, investment spending. And so that means when you're looking at what did investment do when the oil price came down in 86, you have to ask yourself how much of that is coming from the Tax Reform Act and how much of that is coming from lower oil prices. And obviously with that just one episode, it's very hard to tell the difference. The second difference is that the cumulative decline in the oil price was about twice as large in that recent episode compared to the decline that we saw in 1986. And the third difference is that in 1986, what we saw had nothing to do with the global economy, whereas one of the big reasons why the oil price came down this time was a slowdown in the global economy, right? So they're not quite the same thing. But if you're trying to control for these differences to the best of your ability, you would say that the responses of consumption and investment that we saw are roughly what you would have expected on that basis. The same models that explain 86 also do a good job at explaining what we're seeing right now. There's one subtle difference that is perhaps worthwhile stressing, and that's in the external balance. When you go back to 86, what happened in response to the oil price decline is that the petroleum trade balance worsened. And that, of course, affects real GDP, right? Now, why did that happen? Well, when the oil price came down, that was bad for oil producers. Some oil producers shut down. There was less oil production. But at the lower oil price, people want to consume more. So how can you consume more if you produce less? You have to import, right? And so that's why the petroleum balance goes into imports. And that was essentially crude oil imports. That mechanism is still there in the data in the current episode, but it is being offset by the increased exports of refined products, which were made possible by shale oil, and that was something that didn't happen in 86. Now, that is one dimension where you see a difference, but of course, we're talking about fairly small numbers compared to the overall message. So just looking at consumption, private consumption, and oil investment private consumption plus non-oil investment compared to oil investment, that's the basic story in both cases. And that story is invariant. So the short answer is there are a few little differences on the margin, but overall the same story.
Yes, I was thinking about this this graph where you show the uncertainty about future price change. And I was wondering, because you seem to say that that uncertainty went up, but that the price
in this period,
yeah, exactly. So uncertainty is going up from June 2014 to June 2015.
Yeah.
But the purchase of cars also goes up, right?
No, the sales of cars are
the sales of car
they're flat over this period.
Are flat. Okay,
right?
So meaning that uncertainty has no effect on the sales.
So the story people are trying to tell is that even though the price of oil went down, which should make people buy more cars, if at the same time uncertainty about future gasoline prices goes up, then people might nevertheless not buy cars. And so then you get this paradoxical result that although oil prices came down, which normally should make people buy cars, they didn't, presumably because of the increase in uncertainty.
Okay.
Right? That was the mechanism. So what we showed is that although there weren't many car sales, and there might be a number of reasons for that, other than the uncertainty story, over this period, there is no direct evidence that would support this uncertainty story because it's at odds with two other pieces of evidence. One was current buying conditions in the survey data, and the other is the fact that people who do buy cars heavily buy light trucks, pickup trucks, things like that, which you would never buy if you were worried about uncertainty. In fact, when I presented this result at a conference, Bob Pindyke looked at this and says, oh, I don't see any spike in uncertainty. Because if there's no shift in uncertainty, then this can't be important, right? If you do believe that that might be an indication of an increased uncertainty, then the question becomes, is that really the story or not?
Yeah, but if you measure uncertainty this way, measure of disagreement among some,
not the same as uncertainty.
But then it doesn't tell you how much of this survey, how many people were more pessimistic or optimistic.
There is a result in the macro literature from other data that says that shifts in uncertainty at lower frequency, we're not talking monthly data here, is positively correlated with shifts in uncertainty. Right? So we're not saying this is the precisely measured correct magnitude of the increase in uncertainty. We're saying if you see a jump in dispersion, that tends to be associated with a jump in uncertainty, whatever that jump is. But we have no direct measure of uncertainty. In fact, the way people have gotten around this problem in the past was, for example, to specify a gauge model on monthly data and back out uncertainty. Now, there are many problems with the use of gauge models in that context. One is that they're backward-looking. But more importantly, if you take a monthly gauge model, and you try to extrapolate from that model the conditional variance going to the future, it doesn't take very long until the conditional variance reverts back to the unconditional variance, which then paradoxically says, if you're thinking of buying a car and keeping it for 5 years, that the uncertainty over most of the lifetime of the car is approximately constant, which means you shouldn't respond at all. Right? So that tells you that that's not the right measure of uncertainty. The other reason it's not the right measure of uncertainty, so there's some recent work, I had a paper with Christiane Baumeister in the Journal of Economic Perspectives about expectations. And I pointed out that the oil price expectations of consumers are quite different from the oil price expectations of central bankers or economists or financial markets. They all have different expectations. If you want to understand why consumers don't buy cars, you need to look at their expectation, not the gauge expectation or the financial market expectation, because they're different. Right? And so the point is, it's very hard to come up with direct evidence on the uncertainty of consumers, which is the only thing that matters here. And that's why we're taking this roundabout way. Yes?
And do US consumers save more money from the last 2 years?
No. No. There was, in the very beginning, there was some preliminary data that looked like maybe a little bit might be moving, and then the data were revised and was gone. So consumers behave exactly as you would expect they spend. And of course, if you just think back to my data on stock returns for candy, right, it's clear where it's going.
Okay, thank you very much, Lutz.
Thank you.
It was a pleasure to have you here. And so thanks to all who are attending here in person. Actually, today is May 2017, but the webcasting of this webinar is going to take place next October. So the following webinar will be that of Florentina Paraschiv in November. So thanks to all, and have a nice day. Bye-bye.